Investing in your startup is probably a bad deal. And you've seen this metric, right? Statistically, between 7 and 9 out of 10 startups fail. So investors are betting on that one outlier. We already know that, but it's not the 1 in 10 that becomes a unicorn. It's actually less than 1 in 1,000. So why even do this? What convinces an investor to invest in you? Let's dig in. Now, a big mistake founders will make is talking about profits in their pitch decks. It's not that profits are bad, it's that they're bad ROI. Now, imagine this scenario where a company raises, say, $1 million from investors in exchange for, say, 15% of the business. Now, that wouldn't be a crazy valuation for a tech startup. Even if it's just a few guys with an idea, it's all about the potential, right? Okay, so the founders take the cash, they spend it well, and they get this company, they grow this company to $10 million in annual revenue. Exciting, right? And this is a software company, so the cost of goods, the software, the hosting, the AI, it's all pretty low, maybe a 90% gross profit margin. But then come expenses. That's your founder salaries, the support team, the development team, the office, the marketing costs, the software tools that you pay for. Now, after all of those expenses, most companies will end up with something in the 10 to 20% range. Let's be optimistic this time and say it's 20%. Now you've got to pay taxes on that, 20% in the US. So you're left with about $1.5 million, which is a lot of money, and it's exciting unless you only own about 15% of the business, like your investors. Because the company can choose to pay dividends to all of its shareholders, but it's not mandatory. And at 15%, investors don't have a real say in that decision. The company might just choose to increase everybody's salaries. And even if a dividend payment does get approved, what they would get is around $230,000, 15%, which they also owe taxes on. In other words, their $1 million investment is gonna take 5 years to get back if the company isn't one of the 9 that die, if the company grows to that size, which is no small feat, if the founders actually choose to pay dividends, and that's just to get back the money that they invested. We still haven't talked about making a return or making up for the other 9 that failed. Now that is the main reason saying profits or dividends is a bit of a flag when talking to investors, because even in an optimistic scenario, it takes too long. Not to mention, it's still very risky. So the way startup funding operates is not under the premise that the company is gonna pay profits, but under the premise that the company is gonna be sold. It's not profits that investors want, it's selling their shares, selling their stake in the company. So let's go through this scenario once again. Same as before, a $1 million investment for 15% of the company. But this time, the company is not gonna focus on profits, it's just gonna focus on growth. Now, growth costs money, and if the company is not profitable, that means they're gonna need more investors to fuel, to feed, to pay for that growth. And as new investors come in, the pie gets reshuffled. The OG investors end up with a smaller chunk of the company, as well as the founders, of course. But what this company is after is growth. With so much funding across so many rounds, they had a lot of money to spend in growth, to beat their competitors, to build a better product, and to market the shit out of it. 7 years after the first round, they reach unicorn status. Their last round of funding values the company at $1 billion. They are the 1 in 1,000. And then a bigger company wants to either get rid of a competitor, acquire the talent, or acquire the technology. And they agree to pay, say, $1.5 billion for this company. So their last valuation times 1.5, just to make sure that all investors get behind this deal. Now, those early investors, who now own just 4% of the company, after all these rounds of funding, well, they're still getting $60 million. That's a 60x ROI in just 7 years. It's better than real estate, it's better than the stock market, it's better than Bitcoin, it's better than a tiny fraction of profits. That is the logic behind investing in startups. It's not profits, it's not small returns every year, but becoming the 1 in 1,000 company that blows it out of the park. For the most part, you can't hit that level of growth, that speed to unicorn in 7 years unless you go through all these rounds of funding and through all of that dilution. It's a very cash intensive bet, and it's especially risky because if at any point between those rounds the company runs out of money, they're done because they're not profitable. Sure, you can fire half your staff and try to operate profitably, but you lose all this momentum, which means that whoever buys you later isn't paying a premium anymore. They're just buying out investors whose money is a bit stuck in this company. VC funds are designed this way. They're not designed for profits, they are designed for multipliers within 10 years or so. Now, the reason I say that this doesn't make sense is that I can see how for an outsider, this looks a little bubbly, right? Kind of like a Ponzi scheme vibe. It's hyping up a company and then selling it while it's hot. But there are real founders building real companies that often do end up with solid profit margins after that very aggressive expansion. But the game that we have to play as startup founders requires us to kind of fake it till we make it. You can always take things slow, play it safe, build a business for profits, slower, safer. And that's perfectly fair. And that's, again, much safer than the other option. And it probably leads to a less stressful life. The difference is that you won't get away with these valuations if you do that. The $1 million for 15% of the company is a tech startup type of deal. Now, if you want to operate on profits, then the type of investor that you should be after is not a tech startup investor, it's not a VC, and they will probably expect a much larger chunk of the company. What company you build is really up to you. But these are two very separate paths, and once you pick one, it's not easy to change halfway. Now, I made one big oversimplification in today's video, which is that tech companies don't really operate as pies, they're much more like bricks. I made a whole video on that. Check it out. Catch you on the next one.